First thing I will say, as I always try and say before making any conference speeches, is every challenge is an opportunity. So even if some of the things which I say about the global economy appear to be quite downbeat, within whatever is downbeat, there is always a business opportunity to exploit. And I always like to stress that because sometimes I think it gets mistaken. So this is going to be a little bit of a Formula One drive through the global economy. I'm going to touch on a number of subjects. If you want to talk about them in more depth, please call me later. So we are in a world of disruptions, rerouting, and there are loads of challenges and opportunities. I generally like to start with whoever's provided us with the latest forecasts. In this case, it's the IMF, and back in July. Most notable aspects of the IMF forecast, pretty much everywhere, with one exception, which was Russia, was revised higher. So that tells you a lot about the world we're living in, because if you actually look at surveys, and I will make this point later on a slide, what we've got, in contrast to the pre-COVID era, is every survey is downbeat, and most hard economic data that comes out tends to be better than what's in the surveys. That is in complete contrast to what we had pre-COVID, where pretty much most surveys overstated actually what was happening. And that's something which we all need to bear in mind. It is basically due to uncertainty. The downgrade to Russia, I think, is well worth noting. The war economy is starting to it's starting to choke on the war economy, and the Russian banking system is literally at the point of collapse. Bad loans are reaching around about 20%, largely because of a very sharp increase in interest rates. But I think the most encouraging aspects of this is there was a massive upgrade to emerging market Asia, plus 0.6. This is only relative to forecasts they previously made in April. So we're now talking about 5.1% for developing Asia. That is a very strong performance. And most notable, above all, when we're talking about trade finance, world trade volumes have been upgraded from 1.7 to 2.6. 2.6% real, this is volumes, not values, so nothing to do with inflation, is actually getting close to what we would expect. Normally you'd expect global trade growth to grow at about 2.5 to 3% in any given year. So that's also very encouraging. Again, the emerging trade volumes were upgraded also very sharply from 3.8 to 5.8. Now, in terms of the global economy, we are in a major transition. It's a confluence of short, medium, and long-term factors. A lot of it has to do with an unwillingness to reform, and hence the resulting rise of populism. It's too much political correctness, and in many cases, it's a lot of resistance amongst the political fraternity, because the only thing that politicians are interested in doing is not being statesmen, it's being re-elected. And therefore, anything which is tackling long-term challenges, no one lays a hand on. And those are accumulating. The worst country at the moment, if you want to actually pick that out, is France, obviously. You've got a country which basically, where the whole political fraternity, since the middle of 2024, when Mr. Macron called that election, have basically been focused on 2027 presidential elections, and no one cares who runs the country or what is done for the country over the next 3 years. That is truly astounding. That is an abdication of responsibility. But it's very typical of the political fraternities that we have around the world now. VUCA, volatility, uncertainty, complexity, and ambiguity have been our watchword for really basically since the onset of COVID and thereafter. We don't have that visibility, and on top of that visibility that we had beforehand, technology is moving forward so quickly that we also don't have the visibility there. But on the other hand, technology is also allowing us to bore down even more into the data that we have to make ourselves innovate, to help us be more efficient. And so we should be actually grateful for this technological leap, even if it leaves a lot of uncertainty. I think the most important of all those, though, is ambiguity. I think the problem, yes, Mr. Trump creates a lot of uncertainty, but it's the ambiguity. I mean, two and a half weeks ago, we suddenly had this list of exemptions of 839 different commodities and sub-commodities appearing, plus another list of 867 on a US executive order, which may or may not be in future exempted from tariffs. That's a very difficult challenge to deal with for everybody. It's made even more difficult when there's a lot of going backwards and forwards, i.e., we're going to do this, and 1 hour later, 2 days later, the policy is not reversed, but is basically either postponed or something else changes about it. That is difficult and challenging for businesses. I think the most important thing in all of this is there's no point in criticizing it. It's not good or bad. You just have to get on with it. That's the fact of the matter. You just have to deal with it. Wasting time evaluating whether it's good or bad is a waste of everybody's time, and it gets you nowhere. This uncertainty weighs on business sentiment. It also demands everyone is a great deal more agile, adaptable, much more risk aware, and that they strengthen existing business relationships. At the end of the day, most businesses, you want to keep the milk pumping, and if you get some extra cream in your business, great, that's extra profits. But if the milk stops pumping, then you've got a problem. Supply chains remain vulnerable to trade tensions, war, climate events, concentration risks, and nowadays resource nationalism. I think the most important thing to remember about the commodity arena is there is no such thing as can't. I've been astounded, particularly over the last 12 years when I've been more in the center, where the commodities have been center. There is no such thing. If we're taking a product A from A to B, and the route at the moment is M and R, basically, if you can't go via M and R, someone else will find another route via Q and J, and it doesn't really matter, but it will be done now. And that is a great thing about the commodity arena, that there is always a solution. Particularly, and if you haven't read it, Jack Farchi and Javier Blas's book, The World for Sale, highly recommended read. And that also comes to the next point, that we're not in deglobalization. We're in reglobalization or rerouting. If you want, the best example of this is EU-Russian trade. Yes, if you actually have a look at the numbers for EU-Russia trade specifically, yes, it looks like it's collapsed. If you then go and have a look at German trade with Uzbekistan, Tajikistan, Azerbaijan, any of those countries in that arena, and you'll suddenly see spectacular growth in exports, 200, 300, 400% in a space of a couple of years. Now, quite clearly, none of those economies are actually importing it into them. We've just rerouted, basically, our trade with Russia. And I think that's also something else important to bear in mind. And you'll also see it, the strength of Asian trade at the moment is really quite difficult to make out. It's very encouraging how strong the growth is, but what we don't know how much of it is actually basically rerouting from China via Vietnam or Malaysia or Singapore or to other destinations, basically to overcome tariffs, sanctions, etc. Very important other point, I think, in terms of the technology boom at the moment and the energy transition. They are both inflationary. And in contrast to the initial technology boom that we had, i.e. the Google, the Metas, all that sort of thing, these are capital intensive. They are energy intensive. They make heavy demands on power, and particularly power grids, and most power grids are simply not fit for purpose. They all need a massive upgrade. And our biggest problem in all of this is that is a huge business opportunity for everyone, but obviously we've also got a competition now coming from the military economy, which basically died at the end of the Cold War, the initial Cold War. As we enter Cold War 2.0, obviously the defense spending needs to rise spectacularly. And that will basically present a lot of challenges in terms of social spending, in terms of the fact that most countries actually have a huge amount of debt, which they are struggling to deal with. Again, that boils down to that political unwillingness to do that. I think it's important to also understand this whole concept of critical minerals and rare earths. None of them are critical. Yeah, most of them are actually very abundant. What we mean when we talk about critical minerals is basically something where we or our friends, our allies, do not have control over the supply chain. And in the case of rare earths, China basically has control over most of the supply chains for rare earths. Now, when you actually look at rare earth mining, it accounts for about 0.05% of the total value of mining output. So it's almost insignificant. However, stopping the supply of something like samarium basically can lead to collapse in supply chains because it is such a small, important component of things like semiconductors. Labor skill shortages are going to continue to speed up automation and digitalization. There's no doubt about that. Clamp down on immigration is going to be a massive, massive problem. As much as I understand people's feeling that they're basically, these foreigners are coming in, they're using our social welfare, they're using our healthcare systems, they're taking our jobs. Actually, in most countries in the developed world, we need constant immigration. Otherwise, we will be short of staff and we will not be able to compete with the major economies in Asia. And that's something to bear in mind. And that's where Mr. Trump's policies at the moment are basically taking the US down a bit of a blind alley, because amongst all the developed nations, the one thing which everyone basically agreed on was the US prospects in demographic terms, because of the constant flow of migrants, basically was much better than China or Japan, let alone any country in Europe. So some quick points about international and regional factors. The US, I think the most under-discussed point is just how much of a boost from the Inflation Reduction Act and the CHIPS Act the US got. Yes, it came at a huge fiscal price, but now tariffs, immigration clampdown, and this policy ambiguity are raising many questions on the US outlook. We're not talking about a recession here, but certainly a much slower running economy. And I think the other thing, which is really quite astounding, is the US hasn't learned a single thing from Brexit. The one thing that Brexit should have taught everyone about is not being an unreliable partner, acting in bad faith. This is exactly the camp which the US has basically strayed into, not learning any lessons at all. And it's all very well to say, I want to boss it, but the Pax Americana is dead. This is a G0 world. No country actually has a particularly strong influence over other countries, and that's going to continue to be the case for quite some time. In terms of China, it is struggling to make this transition from an investment-led economy to a consumption-led economy. It's simply not getting traction. It has a lot of threats from overcapacity, and there is one strong contrast between now and 2015, where it had its last bout of trying to reduce capacity, above all in traditional, what one call old metal bashing industries like steel and iron ore. Now it actually has overcapacity in a lot of the areas in which it's world leader. So in solar panel creation, in EV creation, that overcapacity creates deflation. And that is a big problem. How that it harnesses it, I don't know. What we do know when we're starting to look at some of the trade numbers and you're actually getting a feel for some of the trends is China is starting to flood other parts of the world with the exports which were going to the US, most notably Africa, Southeast Asia, and indeed India. And at some point, the complaints that the US and Europe have about trade imbalances with China are going to feature, though for most of those areas, basically, they don't want to antagonize China because they're too dependent also on Chinese investment. But there is a balance to be struck. You can't carry on creating ever bigger trade deficits in smaller countries. It's just not it's not a possibility. I was going to bring my PC, which is basically about half this size, with me to just underline a point. It's made in China. It's about the size of a little bit more than a small jewelry box. To emphasize it's made in China, to emphasize that China is way ahead of us on a lot of technology. And as much as we don't want to admit it, and particularly the US doesn't want to admit it, we will have to admit it. And in terms of the energy transition, it's way ahead of us. And here, one simple statistic, China now accounts for 72% of all intermediate good production. So the idea that we want to decouple from China is not, it's simply not a possibility. And in terms of reshoring, interesting story you should be able to find on the net, published on Bloomberg the other day, about venture capitalists who had been looking to basically fund a lot of reshoring projects and decided basically, having gone around China, that it's basically, there's no point in going there. Either the Western companies, whether it's European or US, go into joint ventures with China, or they're basically facing, they're investing money which they're guaranteed to lose because they will not be competitive. And it's not just a matter of the energy costs in Europe. It is, in general, the huge investment in research that they would have to do. Eurozone, Asia, should stress, is the world's engine of growth. They have a difficult problem in terms of balancing US and China, but it's something which they have to deal with. Their biggest problem, above all, is most of them are massively overweight dollars. And that was primarily what we saw at the beginning of the year. Asia has accumulated roughly $7.5 trillion worth of dollar assets since the start of since the 1997 Asian crisis, and it's shed about 10%. Eurozone political paralysis remains. It's all very well for the EU to issue directives, but if countries don't want to work together, and if you have countries like France and Germany basically in political paralysis, how can anybody else work with anybody? That is a big problem. The energy and inflation shocks are a body blow to competitiveness, and apart from that, they're also being squeezed by US and Chinese policies, basically to strengthen their own economies while doing nothing to strengthen the Eurozone. Moving very swiftly on, US dollar suffered in the first half of the year from rebalancing as US exceptionalism was unwound. It's a big challenge. What we're seeing now is some stability. Well, we saw some stability at the start of the third quarter emerge in the dollar because a lot of the unwind of basically imbalanced portfolios. Everyone was overweight the US dollar, overweight US assets, because we basically thought there wasn't anything else and the choice elsewhere just wasn't good. A lot of that has been unwound. Now what we're getting is seeing some inflows into dollar assets, but the hedging that we're seeing is actually creating the downward pressure on the dollar because people basically still believe that Mr. Trump would like to see a lower dollar. Notably, this is the first rate cut cycle that we've had since basically the Asian crisis of 1997, which hasn't been sparked by a financial crisis, which is probably why we're struggling so much to make good predictions on interest rates, because every other one, there's been some form of crisis, whether it was COVID, whether it was the 2018 market liquidity problems, the euro crisis, global financial crisis, et cetera, et cetera, et cetera. Tariff impacts are both inflationary and deflationary. I think the most worrying part in terms of the financial sector is there is been a rise in debt to finance tariff liabilities in the US, which is not only bad for margins, it's also at rates which are sky high, it's not sustainable, and one would have to say it's a canary in the coal mine for credit risks. I think there are other innovations there, but that is one particular thing which retailers and wholesalers are doing, which I don't think is going to be sustainable, and therefore the inflationary impact from tariffs will actually be felt much more in this last quarter of the year and the first quarter of next year. It's also true that as much as we talk about goods and services inflation, risks being real, the asset price inflation that we've got and have had ever since we started on this QE adventure, and notwithstanding the balance sheet reduction programs that most of the central banks have, is a massive problem. That is really what is leading to the greatest inequality, because most people can't now afford to actually aspire to buy a home. And that creates a lot of social malcontent. Market liquidity and depth are generally actually very poor. And we also have an additional problem that typical defensive flight to quality, flight to safety moves in markets are actually being undermined by the fact that most markets are driven by momentum trading. So basically, you always get this big skew. So you end up with a situation like we had last week. Oh, the Fed will cut 50 basis points. No, that was what the market appeared to price in, but it's not actually what it really was thinking. What happened is basically there was just an imbalance in the market. So it ended up with so close to 50 basis points being discounted. Banks continue to de-risk trade finance books. Largely, the principle what one can see is what happens is a lot of the banks basically want to reduce the risk profile of their finance books. So what they do instead of financing trade is they basically say they go to the Glencores, the Trafigurias, the Mercurias of this world and basically say, right, well, you've got a 5 billion credit line with us. Would you like to have another 5 billion credit line to go and finance the smaller traders? So they don't have that risk on the book. And, essentially, the big trading houses are able to exploit what are cheap credit lines, relatively speaking, to also increase their businesses. Couple of quick charts. Most important one in terms of this is we've had a roller coaster ride throughout 2024 on rate expectation. We did a 350 basis point round trip in terms of rate expectations. What one can see on this chart, whether it's euros, whether it's dollars, even sterling, we've got much more stability, and that is actually what's given a lot of support to asset prices this year. That lack of rate volatility is basically encouraging people to exploit. Bank of Japan remains the biggest wild card in it. I would expect them to raise rates in October. They will prepare us much better than they did for the rate cut that they made in July of last year. Important thing in terms of the GCC, it has a lot of money. It's attracting a lot of attention as an alternative destination or a point for not only trade routing, but above all processing of metals, and it's being seriously looked at in many ways. In some ways, it will compete with China. In other ways, it will probably do a lot of joint ventures with China. But it is a neutral area, and it has this huge amount of firepower, 4 trillion just in those 6 wealth funds there. And there's a lot more money behind that. And last point is just make this point about how does Trump actually double down on. This is US manufacturing construction spending, as you can see, from 2012 to 2022, when we got the Inflation Reduction Act, doing nothing. Basically very constant, around 800,000, goes up 140% and starting to tail away now, particularly as some of that largesse went. That is going to be very, very difficult to deal with. Mr. Trump reshoring all of this. A lot of it's been done. Mr. Biden did it. Yes, it was fiscally expensive. It doesn't really matter. And last chart, COVID-era spending basically tipped the balance in terms of global debt growth. Most countries are not on a sustainable path. Most importantly, I think, most countries don't now have the fiscal headroom to head off recession. So if we have another pandemic, if there is another major disruption, basically it's going to be very, very challenging without a lot of central bank government bond purchases to actually increase spending, because the path that most of them are on in terms of debt is already a very difficult one. We published a thing called The Ghost of the Machine. That's the link. You're welcome to sign up for it, and let's...
I think we're going to take a seat, and so let's start with kind of a first question, right? So I think your presentation, I think everyone will agree, there's a lot of stuff going on, and you mentioned the world as is G0 environment, right? There's VUCA, right, which is a term which has been around for a long time. Which of the dynamics that you described would you see as kind of most disruptive over the coming 12 to 18 months?
I think it's definitely the ambiguity. It is this, on top of everything else, we've got this ambiguity at the moment in terms of the way the US administration is implementing policy. And then, to throw us another left field item, obviously we have the midterm elections next year. Now, if we were to see a modest rise in US unemployment, inflation picking up a little bit, we're not talking, I'm not talking about 5-10%, but something which moves closer to 5%, then there are a lot of Republicans who are going to be looking for re-election, and they're not going to be backing Mr. Trump. So that will add a lot more ambiguity on top of everything else.
Yeah, I think that's, well, and I'm going to come back to that topic as well. So, I mean, the ambiguity, right? How do you feel that ambiguity is affecting the long-term investment and trading strategies, right? Are companies in a risk-off mode?
I'm not sure that companies are necessarily in a risk-off mode. I think where we're going is in terms of long-term investments, yes, people are not making the decisions at the moment. They're postponing them because they would like greater clarity. If you want another great point example from Brexit, there was been so many delays for so long because the government, the government was changing every 5 minutes, and people said, well, I don't know what my tax liabilities are. What can I write off on a long-term basis? That said, most long-term investment plans, and this is where AI is definitely helping, do need to be much more flexible nowadays. They need to be built-in redundancy because technology gets superseded. And so people need to factor that in. I think where it's really probably doing most harm is in hiring, because people at the moment basically saying, why should I hire more people when I don't know what my liabilities are? And in the US, this whole H-1B $100,000 charge, that's not really going to do much. And that is actually going to inhibit growth in the US. If people don't hire, the economy probably slowed down simply because there's not enough hiring going on. And particularly at the SME level, and SMEs account for about 65 to 70% of all job creation, that's very, very, that undermines the growth outlook.
And so one of the other things you mentioned in your presentation just now was this re-globalization rather than de-globalization, right? So what does that mean in practical terms for the commodity flows and also and financing needs?
Well, in terms of commodity flows, I mean, we can, obviously ADM's heavily involved in the agricultural sector, but if you actually have a look at what's happened with soybean, US soybean exports to China basically almost completely evaporated and completely been replaced largely by Brazil, latterly a little bit by Argentina. So that creates a different type of flow. The other flows then get routed somewhere else. So basically the relationships, the exports are all still happening, they're just not going to where they used to go. So the financing side of it also changes its nature. One notable factor, I think, though, is one would have expected with this much increased volume of trade, not only in, say, soybeans and agricultural goods between Brazil and China, that there would be a lot more supply, there would be more credit coming from China to Brazil, which is not the case. The availability, I remember speaking with someone at another conference, and they said, actually, Brazil's getting no benefit in terms of trade financing volumes from the increased trade volumes with China, which is actually quite surprising. But it also creates a lot of problems.
Okay, there'll be a session later on in the day on Brazil, so it'll be interesting to come back to that one there as well. And then, this kind of U.S. America first strategy, right, which is influencing a lot of the topics we've been discussing so far. What's your view on how that's reshaping global alliances then? If we think about the potential China, Russia, India bloc, and what does that mean for the EU? How do you see that kind of global geopolitical landscape?
It's certainly woken everybody up to an assumption that it was always assumed the US was a reliable partner. It's not. Well, it's not for the time being. And just as a reminder, after the first Biden term, a lot of people thought that things would be reversed. That the first Trump term, a lot of the policies weren't reversed by Mr. Biden, particularly on trade. So do bear that in mind, that people assuming that we'll revert back to what was going on under Biden is probably not actually a safe assumption. I think what everyone is having to do is re-look at their relationships and strengthen them. And certainly, I was at a biofuels conference 3 or 4 months ago in Amsterdam, and it's amazing how many countries, particularly larger raw materials and agricultural producers, are touting themselves as a reliable partner. So that's one aspect. I think it's also, a lot of people are looking at their own ones. My primary concern with Europe is it is looking elsewhere, for instance, in terms of gas. It is looking much more seriously at Africa. A lot of the barriers were either historical barriers, like France and Spain towards importing gas from Algeria, or it's just too risky. So what we've got now is actually a lot of people looking particularly at Africa and saying, you know what, we have to get over this risk. And this is actually an encouraging thing. This is where what I was talking about, that the commodity sector is always ready to innovate. And eventually the vested interests and all those other barriers which people put up about security risk, about financing risk, delivery risk, people will overcome them if you put the right challenge in front of them. And this challenge which the US is putting in front of them, and also the need to diversify. Because I think that's the other aspect of this is people want to strengthen the relationships, create new relationships, but they're also looking at diversification. They've realized the mistakes which were so brutally exposed by COVID that basically, you can't basically put all your eggs in one basket, and you need support. So those are the major trends, and I think it's creating a lot of opportunity. I think above all is finally creating a much bigger increase in intra-Asian trade, which has nothing to do with just China trying to circumvent sanctions and tariffs.
Perfect. Thank you very much, Marc.